What's going on, everybody? Welcome back to my YouTube channel. Now, most traders cut their profits way too early, and that's why their return on investment never grows. So today I'm going to share with you how to squeeze the full range out of every trade and share three powerful techniques you can start using today that can turn a 2R win into a 5R or more move. Now, if this is your first time on the channel, welcome. I'm a pure price action trader, and my entire focus is on trading a single candle and squeezing the maximum range out of it using precise scaling down techniques. And I trade a concept called 2CDT, two candle deviation theory, one pattern, one process, zero confusion. No indicators, no noise, just structure and discipline. So if you're serious about mastering trading without overcomplicating it, then you are in the right place. Let's go. So the first thing I want to share with you guys is this reference that you're going to see here. Now, this was a trade that was sent in by Marco yesterday, I believe it was. And the reason I'm sharing this with you is because most traders take profits too early, including myself. I'm not immune to this. And what you find is they hit a 1-to-1 risk reward ratio trade, or they target a 1-to-1 risk reward ratio trade. They end up closing the trade, or the trade ends up getting closed out. And then, as you probably can see here, price continues to go in their direction. Now, this is not uncommon, but here's the thing. The difference between breaking even and scaling to six figures or more is not about more trades. It's about maximizing the ones that you already take. And as you could probably see here, as a reference, we were just talking about how we would enter this trade, etc., based on the criteria here. And if, let's say, in your plan, you were going for a 2R target, then this is where your TP would have been. But as you can see, price continued to push higher. And the reason I'm doing this lesson for you today is to show you how we can maximize these positions in the right conditions, especially using higher time frame and lower time frame structures. Now, if you can see here as well, this is Adriano. He's obviously another member in NDS. And about 2 weeks ago, I mentioned to the community that the potential for the 2CDT strategy is ridiculous. And we need to start pushing our boundaries a bit, going for bigger targets. Adriano was the first person to hit the 5R after that lesson. And in actual fact, I didn't include it in this slide. He went on to hit another one. I believe it was the next day. So it was like 10R in 2 days. And then less than a week later, he passed a challenge on one account and got funded on the other. And the reason that I'm sharing this with you is because comparable to this reference here, we didn't maximize the position. And with this reference here, you can see that Adriano did maximize the full position. So the difference is this: if you're risking 1% per trade and you're hitting 2R, that's going to give you a 2R return, right? Naturally. But if you take the exact same trade, you manage it differently, then that can give you 5, 7, 10, even more R on the trades that you're taking. And that's how you're going to find yourself passing challenges, building payouts faster. And the truth of the matter is, it's not about the strategy you're trading, it's simply maths. And I'm going to share that with you in 2 seconds. I also want to just say this as a disclaimer. This is not financial advice. This is for educational purposes only. And on top of that, not every trade you take will you be able to squeeze the maximum. However, when the markets provide you the opportunities to do so, I'm going to share some examples down here with you in a moment, then it's definitely worth taking the risk on your investment. That's what it is, ROI. Because here I got this chart drawn up, okay? And this is what we call risk to reward versus ROI. And this is just based on 10 trades and a 40% win rate. Now, 40% win rate obviously isn't massively high, but neither is it low. And to be frank, you don't really need much more than this, but if you do, fantastic. But let's just say if we're going for 2R targets in terms of our risk to reward, and out of those 10 trades, we win 4 of them. Okay, so we win 4 of those trades. We go for a 2R target. That means out of every 10 trades that we take, we're going to make AR. Okay. Now, out of those AR trades, we're clearly going to lose six of them. And if we minus that from the profits that we made, which is this here, then that leaves us on average, not literally, on average, with a plus 2R return on our investment. Okay, that's going for a 2R target. Now, if we go for a 1 to 3 risk reward ratio, again, based on 10 trades with a 40% win rate, and we win 4 out of every 10 trades, that means that our return on investment is going to be 12R. Now we're going to lose 6 of those trades, clearly. Again, in the same scenario, that means that our reward in the end is going to be plus 6R. Okay, that's based on a 1 to 3 risk reward ratio. Now, if we go for a 1 to 5 risk reward ratio, that means, again, out of every 10 trades, we're going to win 4 at a 5R return. And that is going to give us a 20R return on our investment at the end. But bear in mind, we're going to lose 6 trades, which simply means that we're going to make plus 14R at the end. Okay? Let's do that clearly. Plus 14R. Now, here is one thing to bear in mind. This is plus 14R with a 5R risk to reward. This is a 6R return on our investment based on a 1 to 3 risk to reward ratio. And this is a plus 2 return on our investment based on a 2 to 1 or 1 to 2 risk to reward ratio. But in all scenarios, we're taking 10 trades and we still have a 40% win rate. So some of you might say, well, yeah, we don't hit those 5R trades or those 3R trades often. It's not about how often you hit them in the short run, guys. It's how often you hit them overall. So the sample size we're using here is only 10. But if you're taking 25 trades or 40, 50, 100 trades, and you're still managing to get yourself a 40% win rate, then this is going to be your return on your investment. This is just basic maths. So once we understand the basic maths, then it makes it a lot easier for us to focus on going for bigger targets when the opportunity arises, as opposed to settling for just 2R, focusing on going for bigger targets so that we can maximize the return of our investment, so that we can allow the maths to do the heavy lifting for us. And that's what we call our edge. Now, just as an example of that, once Adriano entered that 5R club, it raises the ceiling for everybody, especially when you're in a community. You can see that it is possible, and there's no reason now to go for those 2Rs, 3Rs, or 4Rs. In actual fact, it's much easier to target it. And it's like when man went to moon. Once somebody does it once, somebody's going to do it again. When somebody creates an electric car, let's just say Tesla, then another manufacturer is going to do the same thing. Okay. So I think it was about 10 days, 2 weeks later, I managed to get myself into the 5R club. I made it, mum. And this came off of the back of some trial and error, to be brutally honest with you. The week prior to this, I was attempting to get into the 5R club myself personally. And during that period of time, believe it or not, I'm probably going to get some comments in the comment section. I gave back 18R. 18R that week. I had 4 trades, I believe it was. One of them went to, it was around 5.5R, almost 6R. Second trade went to, again, another 5R, and another one went to around 6.5R, along those lines, and then I end up losing one. Finished the week minus 2R the week before. Last week I came back in and I finished the week plus 11R up, which was very good. This 7.5R trade and another 3R trade on Thursday or Friday, one of the two. But anyway, the point that I'm trying to make here is once the ceiling has been raised, Adriano comes along and takes not just one 5R trade, he took 2 in 2 days and absolutely destroyed it. And he's continuing to do so. This opens the doors for us to do it. So I took the trade and I took the 7R trade. Now you think this is impressive. Okay. And this is why I'm going to share these three powerful techniques with you because I'm going to show you how you can maximize these. I took 7.5R from this trade. Here, as you probably can see, Maya, who is a mentor in NDS, took the exact same trade, but was able to maximize the position. So I got 7.5R. Maya was able to maximize the position and he got over 10R on this trade. We both took the same trade. I didn't know he took it. I posted mine first, obviously, because I got 7.5R and he posted his after mine because he was going for a bigger target. But here's the point. In the right market conditions, you can maximize these positions. Okay? There's a little rhyme for you. So that's what I want to share with you today. We'll move back over to our first example. Now, here's what I want you to take a look at first and foremost, okay? In order to be able to maximize your positions, the first thing that we've got to do here, guys, is we have got to squeeze the full range from a single candle. So the first example that we have down here, which is this one, is a buying example. And what we want to be doing is looking to target the high of the previous candle instead of settling for a random risk reward ratio trade. So let's zoom in on this and let's get this in the picture. So what do I mean by squeezing the range of a candle? Well, as you can see in this example, we have a very strong bearish candle. Now, on every single time frame, without a shadow of a doubt, a candle will have an average true range. Now, I don't use the indicator. I personally just use the candles themselves and just see them from a logical perspective. And if you look at the range of this candle comparable to the last 3 hours, you can clearly see that this is an overextended candle. Now, in order for this market to continue to go bearish, you're going to need a news catalyst, an economic event, or you just some wild tweet from Trump. Now, once you can identify that there's, let's say, an overextended candle in this scenario, you then need to validate a potential setup by using patterns. And that's where the candle deviation theory comes into play alongside higher time frame analysis and trading one single candle and maximizing the range. So if we look over at the 1 minute time frame, you can clearly see that price has been failing to break this structure. Okay, so the simple theory is if price is failing to break the low and it's not going down, then it must go up. All right. Off of the back of that, we also have an added confluence, which is a really overextended hourly candle. And again, only a news catalyst or economic event or a tweet from Trump can continue to send this down. Once we see evidence of the failure to break plus the extended candle and we see a shift in structure in the market, then this is a high probability trading setup because everything aligns with the idea that price needs to pull back. However, in order to maximize the position, we have to understand how we maximize it. And in this scenario, what we are looking to do is we are looking to target the high of the previous candle instead of settling for a random risk to reward ratio. So when we're looking at this here, what we're saying to ourselves is, okay, I can look for a retracement back to 50% of the previous candle, which is this here, and potentially target a 2R trade. But in theory, when we're using this powerful technique, there is no reason for price to stop at the 50% range. So that being said, from past history, that means we should effectively be targeting the previous candle's high, which is this candle here. So that now increases our trade from a 2R trade back to the high of that candle, which in fact gives us a plus 4.3R return on our investment. So over the period of 10 trades, let's say, if we do the maths here, I'm not going to do this for all of them, but just as an example, if we have a 40% win rate, we get 4 trades that win at 4R. That is a 16R return investment. We always minus 6 with a 40% win rate with 10 trades, and that gives us a plus 10R return on our investment. Now, what do you need to pass a challenge? You need either 8 or 10%. What do you need to pass a verification? 5%. So just a single percentage risk on this trade will see you over a period of 10 trades, average it out, of course, if need be, with a 40% win rate, passing a challenge, getting funded, and or getting a really nice fat payout. So the principle here is this. You want to be targeting these highs. Once you can see that price is failing to continue bearish in this instance, you get the evidence from the 1 minute time frame, which is a shift in structure, then target the highs. Maximize the position as much as you possibly can. That's a selling example here. Let me share with you a buying example. So as you can see here, oh, sorry, this is a buying example. Beg your pardon. Let me share with you a selling example. So again, for sales, we want to be targeting the low of the previous candle to capture the full move. It's as simple as that. Okay, the theory is simple. It's not complicated. So if we look at this example here, what we can see is that the previous candle in this instance has pushed bullish. Now, this candle is coming into an area in the market where price has previously illustrated there has been a reaction from. Okay, so we have a strong bullish candle coming into an area of resistance in the market, simple price action. Because we trade one candle, we're looking for a shift in structure. So from a 1 minute perspective, we can see price pushing bullish. We attempt to go bearish and we fail. We continue to go bullish. And as you can see here, we have a nice deviation in the market where price is continually making lower lows and lower highs in this sequence. And then what we're looking for here is a break of this low. And what we're anticipating when we see this is price to create this sentiment. Okay, this sentiment which illustrates a potential new downtrend that's forming. So alongside price flipping bearish on the hourly candle, a failure to break the low, a shift in structure on the 1 minute time frame, we can now take the sell. That being said, instead of going for a 2R target, what do we want to be doing? Well, we want to maximize the full range back down to the low of this candle. And as you can see, this is the wick. Price came all the way back down. And in return, we get a 4.5R trade. Okay, very simple. So the theory is this: when you're buying, just target the high of the previous candle. If the previous candle range, let's say, is 2R, then just go for the 2R. I'll show you another scenario why you'd go for more. But if it does give you more than 2R or 3R or 4R, then go for it. Push the boundaries, raise the ceiling, because an additional 1R or 2R on your profit factor is going to massively change your results. Sell example, the same thing. Target the low of the previous candle to capture the full move. That's all we're talking about here, okay? Now, let's move on to this example here. This powerful technique, the second one, is maximizing the range with higher time frame structure. So the previous was maximizing the range of the previous candle and using the 1 minute. This is now maximizing the range with higher time frame structure. So for a buying example, what we're looking for here is this. If the trend on the higher time frame is simply trending bullish, all we're going to be doing is buying from the higher low. It's that simple. So if the market is going bullish, we are looking to buy from the higher low. Don't just stop at small targets. Trade it back to the high. So this being the high, or trade it beyond that to the new higher high that is going to be formed. Okay, so simple theory. When you're buying in a trend, you want to buy from the higher low in anticipation for price to come back to the higher high to maximize the range, and or higher than that, because we know in an uptrend, price will make a what? Higher high. Okay, so the example of this is this. Here you can see on the hourly time frame, price is clearly trending to the upside. Now, once price pulls back, what do we see here? We see a higher high, a higher low. Now, there's two ways we trade this. The first red line is indicating to us this red line here. So this is trading back to the high. And in this example, you can clearly see that we get a 3R return. Now, because we're in an uptrend, what we anticipate in an uptrend is for price to make a new higher high. So if you want to, in this scenario with this structure, go for much more risk to reward on your trades, then this is the right conditions to do it in. Because once price makes a higher low in a trending market that is clearly bullish, we anticipate naturally for price to get back to the high, and even more so to make a new higher high. So here in the first example, you can happily settle for 3R by just going back to the high, or you can push the trade just a little bit more further and go for a bigger target. Okay, so the principle is very simple. Now let's move over to a selling position. Same thing. If the trend is going bearish on the higher time frame structure, okay, so as an example, if the market is trending down on the hourly time frame, let's say, we're going to sell at the lower high. We can sell back to the low, which is going to maximize our range, or in a downtrend, we know naturally price should make a lower low. In that instance, we can look for a continuation into a new lower low forming and maximize the potential of that range. So an example of that is here with these cells. All right. What you can see here is that the market, clearly from a price action perspective, was ranging. Now, you can trade ranges and I'll share something with you in a minute. But once we break out of that range, in theory, the directional bias now has shifted to being bearish and we are looking for a lower high pullback to look for a selling opportunity back down to the lows just in case it doesn't break, or even further to make a new lower low. And in this instance, you can clearly see again, we have price trending to the upside. We have a break of that higher low structure. So we're no longer going bullish anymore. We create a new low, a lower high. And as you can see from a 1 minute perspective, all we're anticipating is a trend back down to the downside with the higher time frame trend. The red line illustrates here back down to the low for a 2.5R return, which is an example that I just mentioned earlier on. If it's just 2R or 2.5, take it. And or if you can clearly see that the trend on the higher time frame is trending, maximize the position and go for bigger targets. Okay, so it's very simple. If the market is trending down, sell at the lower high, maximize the range back to the low, whether it's a 2.5R or a 4R trade. And if you can see that the conditions are favorable, then continue to maximize the position and go for bigger targets. All right. So this example here is very, very simple. With the previous example, we are talking about maximizing the range back to the high of the candle or low of the candle. This one, we're maximizing the range with higher time frame structure. The final and third powerful technique is called or not called, it is maximizing the range in a consolidation. So if we go back to Maya's trade here, my trade as well, but this is a better illustration. You can clearly see that price has created a low point, a high point, a failure to break that previous low point, and a failure to break that previous high point. You do not need this point to make a consolidation, but once you have this and you have evidence of this, you can now start to see that price is moving in this directional bias. And this is what trading is all about. Getting very familiar with your structures and identifying when a potential range is developing or developed at the earlier signs and when price is trending at the earlier signs, and that will help you to maximize your position. So you can see here with Maya's trade, it is ranging clearly and the position was maximized back to the high. This is where I took profit, which was here, this red line, because in my idea, this is an overextended candle into a wick rejection area. So I was happy to take 7.5R from this, but Maya was happy to maximize the position all the way back to the high. So if we take a look at how we work this, with a buying example, if price fails to break the low of a range, so if we see price failing to break the low of a range and there's a reaction, we have 2 points of contact here, then it is more likely, if it's not going down, it must go up. So we can then maximize this range all the way back to the high. And I'm just going to keep it very simple. For a sell example, if price is bouncing up and down and failing to break the high, and we've got 2 reference points. If it's not breaking the high, then it must go down and we can maximize the range back down to this low. So here I have 2 examples for you. This is the first one. As you can see here, we have enough information on the hourly time frame to illustrate to us that price is failing to break the high. We've got multiple wick rejections here illustrating a lack of that bullish sentiment. And as you probably can see here in the market, on the 1 minute, we have price failing to break. We have a somewhat uptrend, and then we have a shift in structure, which creates a lower high formation in anticipation of a downtrend. When we enter the trade here, we are entering when the candle flips bearish. So again, trading one single candle. When it flips bearish, it must continue to go bearish. We are not looking to jump in front of a moving train. We are looking to join that movement. And as you can clearly see, the first target is the structural low of the range, giving you a 2.44R return on your investment. Now, if you want to maximize a position and there's momentum in the market, and or you see a bigger range and a smaller range with inside, and price starts to break the smaller range, then you can start to target the bigger range back to the downside. So here again is the same principle. There's a wick rejection. Once price gets to this level, we're looking to manage this position and or take profit, which is a 5.88R return. But if you're looking to maximize this position all the way down to the range, then there's an opportunity for you to maximize this. Where is this? Hold on a second, my people. Oh, okay, fine. I cut the screenshot too early, but doesn't matter. And then you can maximize the position. You can see on the hourly that we got there all the way back down to the low, which is this return here. So the principle is simple. Once you're in a range, you can target the low of this range. If you start to break the range, you can start targeting the low of the major range. If you see wick rejections, you can take your profits there. And if you have faith and you want to hold your positions all the way down to the low, which you got to, then here you go. You can maximize your positions. Even a 0.44R additional extra reward on your trades is going to massively increase your profit factor, no matter what you go for. So that's the selling positions. If we go over to the buying positions here, as you can probably see, it's almost identical. Here we have an example of price failing to break the structural lows. Okay, multiple wick rejections. We can also add in there that price has been sitting here for a very long period of time. You can throw in what you want as long as the story makes sense according to your plan. We also have here 2 candle deviation theory trade. Price has closed bullish, or the previous candle has closed bullish. And what we're anticipating here is for price to continue bullish. We have a continual movement in the market. You can see that price opens, creates a bottom wick, which is the anatomy of the candle formation. Wick first, then body next. And then we can target the highs of this trade all the way back to this red line, which is the top of this range for a 4-hour return on investment. Okay, so very, very simple here, guys. And these 3 powerful techniques can be applied to any strategy, not just mine, not just yours, any strategy. And the key takeaways is if you can just push yourself to go for that 1R extra, it is going to make a huge difference with your profit factor. So guys, squeeze the range or the full range from a single candle, okay? Trade it back to the highs or lows. Maximize the range with higher time frame structure. If the higher time frame structure is clearly illustrating it's bullish or bearish, then look to trade it back to the highs or lows, or even go for the higher high or lower low in those within those structures. But then if you see prices ranging, which technically I've given you all 3 market conditions that you'll ever be trading, maximize the range in those consolidations, back down to the lows and highs when given the opportunities. So that's the lesson today. How to maximize your positions to the full potential and stop leaving profits on the table. I hope you enjoyed this lesson. If you did, guys, do me a big favor, hit that like button for me, subscribe, turn on notifications, and as I always say, continue to trust the process.